What is short selling? This video covers how short selling works, the risks of short selling, and hidden costs and fees. We have two ways to make money in the stock market. One is to take a long position, and the other one is to take a short position. When we buy a stock at a low price, and if the price of this stock goes up, we make money. I think this is very easy to understand. When you want to say, I want to buy Apple stocks, it's equivalent to saying, I want to long Apple stocks. When you already have Apple stocks, it is the same to say, I am long Apple. So now you understand that the word long is to own or to buy a stock, and the short selling is the opposite of that. A short position is the sale of a stock that you do not own. If a stock is going down, can we make money from that? Yes, we can short a stock to make money. When you think the price of a stock is too high and you predict that the price is going to fall, you can sell a stock that you don't have and buy the stock back later when the price is lower. This is a short selling. It's basically betting against a company or even the whole market. Let me give you a quick example. Let's look at this chart right here. All right, this is Apple's chart. In January, it was trading around $145, $144 right here. Now, some people, they think $144 per share. I think that's a little bit expensive. It's trading too high. So now they think for the next week or for the next month or today, they think the price is going to fall. You can short. So basically, you don't have any stocks, but you can sell right here. Of course, if you want to short, you have to have a margin account, and I will talk about it later. So you want to sell it, you don't want to buy it because it's a little bit too expensive. So now you want to short Apple, and the price you sell is around $144. Now let's see, it's kind of going down right here. You see that? 142, 140. 134. So right here, in about 4 days, the price of Apple dropped from $144 to $134. So if you have one share of Apple, you made $10 because you sold Apple around $144. You bought one share of Apple around $134. So if you have 100 shares, you made $1,000, which is really good right there. One more example. This is Amazon. Amazon was trading around $3,548. So now you think the price is really high, and you think for the next few days or a few weeks or even months that the price of Amazon is going to fall. So now you can short it. So basically you sell it first. You don't have any Amazon stocks, but you can borrow it, and your broker, they would lend you stocks. So you want to sell it at $3,548. And the price of Amazon, you see that it's going down right there. In about a week, from $3,550, it dropped all the way down to $3,300. So you made about $250, and that is really good in just about a week per share. So if you have more shares, of course, you would make more money. That's short selling. So some people might wonder, how can you sell a stock, sell something that you don't have? So basically, your broker would lend you a stock with a small fee. And that's why they're willing to lend you some shares, because they are also making money. And sometimes your broker would borrow stock from some kind of investor as well, and they would pay them a small fee as well, and you would pay your broker a little bit more than what they pay to that investor. So you get your share, and your broker make a small profit on the fees, and that person or investor who lends the share to your broker also makes a small profit, and that's why everybody's happy, and you get your share to short. Short selling is a risky way to profit because it's different from buying or longing a stock where your loss is limited. If you buy a stock at $100, your maximum risk is to lose that $100. But if you short a stock, your loss could be unlimited. Let me show you this on a chart here. Now, let me give you one example. When you long a stock, your loss is limited. Let's look at this chart right here. This is Tilray, and you see that right now, Tilray is trading around $140. In September, that it was trading around $300. Now it's $140. And you think, hey, this price is going to go back to $300. Well, you bought one share of Tilray at 140 and you are hoping it's going to go to 300. Let's see. After about a month or so, it's trading around $95. So from $140 now to $95, so you lost about $45, and that's not very good per share. And now you think, oh, it's going to go up, somehow if I hold it long enough, it's going to go up again. Now let's fast forward. Oh, not really. You see that now it's trading. Now in March, it's trading around $70. So from 140, it dropped 50%. So now every share is worth $70. So you lost $70. And now let's fast forward more. Oh, now you see that? Now it's trading around $19. You lose more money. But no matter how low it gets, it traded around, in March, it traded the lowest, it was $2.50, around there. You almost lost everything right there, right? And that was horrible. But you see that? No matter how low it gets, your maximum loss is going to be $140. So basically, when it goes to zero, you cannot lose more. So that's when you long a stock, your maximum loss is limited. Now, let me show you another example where your loss is not limited if you short a stock. Now let's look at Amazon. You want to short this stock. So now Amazon, the price is around $106. Let's just say $100. So now you think, hey, you tested this high right here. I think Amazon is not going to go above 113. So I want to short it. I think it's going to go down to $45 or so. All right. So you short one share of Amazon at $100. So you see, oh, it's going your way. You see that, oh, you're happy now because it's going. So from 100 now is 62. You are happy. You think, I think it's going to go down more. But, oh, it is going down. You went all the way to $8 and you are happy, but right here you didn't cover it. You still think it's going to go down more, but now you see that it's coming up, and now Amazon is trading around $170. So now you lost $70 because remember you shorted Amazon at $100. So you borrowed one share. Now you have to buy back one share at $170. So you sold Amazon at $100 and you bought it back at $170, which means you lost $70. And now let's say you didn't cover your position, and let's move forward to now. You see that? Now Amazon is trading around $3,600. So that means you lost $3,500 because you shorted Amazon at $100, and you must buy one share of Amazon back to return what you borrowed, and now the price is $3,600. So now from 100 you shorted, you lost $3,500 per share. So if you have 2 shares, you have to double that. If you have 100 shares, you have to multiply your loss by 100. So that's really crazy. And let's say that you didn't stop right here. So imagine if Amazon goes to 10,000, 100,000, what about 1,000,000? That's what I meant, that if you short a stock, your loss is not limited. So if it reaches a new high, you would pay more, and there's no limit how high it could go. So it's a very risky way to profit. So you have to be careful, and that's why we have to have a margin account to short. So usually with your cash account, you cannot short. Now let's talk about what is a margin account and what is a cash account. What is the difference between a cash account and a margin account? A cash account is that you can only trade with the cash available in your account. So for example, if you have $1,000, you can only trade with that $1,000. And sometimes trades, they have to get settled. Let's say today you bought $500 of stock, and the next day you sold $500 of stocks, and now you think, oh, because I sold it, I have $1,000 again. No, sometimes you have to wait for a few days to get that $500 settled. So now that's what a cash account is. You cannot trade with leverage. You can only trade with the available cash in your account, and you cannot short because brokers, they know some of these new investors, they don't understand the risks of shorting, so they do not let cash accounts short. They wouldn't let you enter a short position, whereas a margin account is different. A margin account, you can leverage. So that means if you have $1,000 in your account, if it's 2-to-1, you can trade $2,000 worth of stocks. If it's 4-to-1, you can trade $4,000 if you have $1,000 in it. So basically, it depends on how much money you have in your account. That's margin account. And you can also short a position with a margin account. So that's basically the difference between a cash account and a margin account. So if you want to enter short positions, you should call your broker and tell them that you want a margin account. In conclusion, we talked about what short selling is today. Basically, you are betting against a company or the whole market. You think the price of a stock is going to fall. That's where you enter a short position. The lower it gets, the more money you make. And the risks, that is, with the short selling, if the price of the stock goes up, your loss is unlimited until you cover that stock. So it's kind of risky. And also, we talked about the hidden fees. And when you short a stock, you need to pay a small fee to your broker because you borrowed a share and you have to pay them a little bit to get that share. And at the end, we talked about you cannot short a stock with a cash account. You have to have a margin account in order to enter a short position. Okay, and that's it for today's video. If you like this video, please hit the like button and subscribe. This is Grant. Trade and invest responsibly.